Welcome to Pioneers in Payments, where payments experts share their insights. Now, here's our host, Donna Blum.
Hello, everyone, and welcome to this edition of Pioneers in Payments. Today, I have the opportunity to welcome back Eric Grover from Intrepid Ventures. Welcome back, Eric.
Thanks, Donna. Happy to be here.
I'm so glad you're with us again. So, this episode is really kicking off 2024, and so we just kind of want to talk a little bit about what we can expect from the coming year, and also just sort of share some optimism about all that's happening in the industry today. But before we get started with that, Eric, would you mind sharing a little bit with our audience again about who you are and your background in the payments industry?
You bet. So I'm a payments consultant. I've been a payments consultant now for more than 20 years, providing corporate development and strategy advice to payment networks, processors, service providers to the industry, folks that are investing in the payments industry. Prior to consulting, I was with GE Capital's credit card business, what's now Synchrony. I was with Visa International. I was with Bank of America. I was with Nations Bank's finance company. I was with Transamerica. I was on the board of Nordstrom's credit card receivable subsidiary as a non-executive director for about a decade. I was head of corporate and business development for a credit card software company for about a year. That's where I'm coming from.
Well, everyone, so grateful to have Eric back today. He just has a wealth of knowledge about the industry. As I mentioned, this is the beginning of 2024, so Happy New Year, everyone. But Eric, let's start off by just talking about what maybe we can do a little bit of a summary of 2023. You wrote an article that and I read that article that talked about some of um, the financial strength and how some of the larger players in the industry did and how some of the smaller players in the industry did. Would you mind giving us a little recap of that article and your findings?
Sure. And it's maybe a little bit of a head scratcher, but so the payment sector has been and continues to be very healthy in terms of transaction and volume growth, in terms of revenue growth, and frankly, in terms of prospective growth out over the next decade. And a lot of investors, private investors and public investors, have enthusiastically bid up valuations of private and public companies. And those valuations in 2023 were quite heady, and they were based on a combination of factors, some of which have changed. So they were based on coming out of an environment of low cost of capital, almost free capital. The Fed, literally the Fed's benchmark interest rate in real terms had been negative for well more than a decade. And that helped inflate valuations enormously. Additionally, investors rightly looked at the payments industry as throwing off annuity streams of revenue because pricing is anchored off of numbers of transactions, payment volume, numbers of accounts, all of which in most markets are growing at a very healthy clip. And so that combination bid up valuations. However, with the Fed's benchmark interest rate, the Fed, bringing interest rates up appreciably, there was a real cost of capital that has affected valuations not only in payments but across all sectors. But payments was hit much more severely than the entire market, most of the payment sector. I think many investors looked at the organic growth rates in companies as being sustainable for forever, for a long time. Many or some investors assumed network economics in payment processors that aren't really there. So, I mean, and I my view is that a payment network at scale, is fundamentally a much better business than a payment processor at scale, which isn't to say that some processors don't have platforms within them that enjoy network effects. But the pure networks are more defensible, entry barriers are higher. Many of them enjoy pricing power, and in general, processors don't. And we saw last year, and this kind of epitomized it. There was a single day in August where Adyen, high-flying payments phenom, Adyen, great payment processor by any measure, their stock price fell 36% in a single day. And it was based on they projected that their growth, which continues to be greater than the market, was going to be a bit less than forecast. And there have been some recognition that payment processing is price competitive, and that which who knew? I mean, that's so. And then Worldline, which is certainly in the same business as Adyen, but broader, has a portfolio of card issuing, processing businesses, payment networks in several countries, merchant acquiring and processing, and they unlike Adyen, which issues acquisitions, builds everything from scratch or has to date. Worldline is a consolidator, and Worldline had been selling the market for a long time on its prowess consolidating, rationalizing, and also this notion that there are synergies across these different related businesses, and that those synergies not only are there cost synergies, but there should be revenue synergies. I think it's clear that they have been able to and continue to realize some of the cost synergies, consolidating redundant platforms. The revenue synergies, it's not so. They've struggled to deliver there. And again, what happened, I think, was the markets were spooked when they guided somewhat down in their growth. Still growing, but not double-digit organic growth. Now, those are two vivid examples, but if you survey the entire payment processing market, with a handful of exceptions, the companies, some great companies, their valuation multiples plummeted. Now, some of them have come back some, but they plummeted on just a changed perception of the entire sector. It's unfortunate. I think it also will augur in an age where we're going to have some more consolidation, and among private companies, there are probably too many so-called fintechs funded in too many sectors, and companies that have capacity will opportunistically scoop some of them up, which ultimately will be healthy for the market. But I certainly, the year was a tumultuous year in the markets for payments. Although again, from a growth perspective, pretty healthy, and while there are a range of forecasts about future transaction growth worldwide, future payment volume growth worldwide, future revenue growth worldwide for the payments industry, without exception, everybody is forecasting pretty robust growth, healthier, stronger growth, outside of the developed North America, Europe, which is not surprising. But nevertheless, even in the U.S., Canada, Western Europe, growth is still reasonable. But if you take a global perspective, and we are in a global industry. If you look across Asia Pacific, LATAM, growth rates, organic growth rates, are really robust and likely to remain so for a long time.
That's excellent news for the industry. So let's sort of, if we had a crystal ball and we could look forward to, what to expect in 2024, what kinds of trends do you think are going to emerge that are going to drive that growth?
Yeah, I think, well, there's some good trends and maybe some not so good trends. mean, the good trends, I think, clearly the long-standing trend of cash to electronic conversion continues in almost all markets. Which is not to say, I think there's been hype that physical cash is going to go away, and I think that's highly unlikely in our lifetimes. Certainly there's some markets where it's becoming far less common for retail, but physical cash is not going to go away in our lifetime. And actually, physical cash in circulation in almost all markets continues to grow, notwithstanding that the use of it at retail is not growing in most markets. But electronic payments in both traditional quote unquote card systems, and I say quote unquote card systems because we have to bear in mind the card is simply one of many form factors to manage payment credentials. But traditional payment systems and the so-called alternative payment systems are all worldwide growing at a very healthy clip. That's going to continue. We have a patchwork, if you will, of maybe two truly global retail payment systems, Visa, MasterCard. You could throw in SWIFT for cross-border interbank payment messaging as global. Half a dozen weaker tier 2 multinational networks, among which I would include PayPal, American Express, Discover, Alipay, WeChat Pay, and then literally hundreds of both card payment networks and alternative payment systems, which at the physical point of sale are principally national, but have some utility for e-commerce. For consumers in their home markets, which is an interesting, competitive landscape. And then, of course, in all markets, there is a robust landscape of processors delivering those services. I think that we will continue to see, both through consolidation, acquisitions, and greenfield efforts, company processors continue to try and expand to additional markets to buoy long-term growth, certainly the larger ones. And if you looked at the largest payment processors in the US and in Europe, they all are multinational, and they are all with varying degrees of vigor attempting to become more international. And I think that just, if one wants to buoy growth for the next 20 years, you don't want to be 100%, a U.S. or U.K. or French company. You want to have exposure to higher growth markets. And in payment processing, there has been far less protectionist impediments to expansion. We see in the domain of networks, payment networks, many countries are imposing restrictions, burdens on foreign networks competing, favoring national champions. I think that's unfortunate. And while we can find cases of that with processing, they're less common. So I think that's all good. I think the industry continues to find effective ways to wrap additional value around payments. That's a long-standing trend, and it's good for a number of reasons. One, because if you're a processor and you're wrapping more value around payments and delivering it to your business or merchant client, you're delivering more value. Clearly, if you do that, the relationships are stickier, your fees are more defensible. So that's generally good for the industry. I think I worry some about continued regulatory interference in the industry, in industry pricing. That has not, in most markets, been so much of an issue for pure processors. I mean, we can find some markets where merchant discount fees are regulated. India caps debit merchant discount fees, which is a really wrong-headed policy. Nevertheless, they do it. But far more common has been regulators capping or imposing price controls on network interchange. And we've seen that in the EU, we've seen that in Australia, we've seen that in the US, and we've seen recently a number of instances of that being stepped up. So the Canadian regulators just recently announced an agreement with Visa and MasterCard and Canadian banks, under which they agreed to lower credit card interchange for small businesses by roughly, recollection is 28%-ish on that order of magnitude. And so this wasn't a law. It wasn't even a regulatory diktat. They jawboned the industry into doing it. And I was really struck by a press release that the finance minister put out assuring Canadians that this would have no impact on credit card rewards, and which I thought was a bit disingenuous, since unless the Canadian banks are going to increase fees or they're going to reduce profits for shareholders, which would be ways to continue to maintain rewards, they're going to have to reduce them. We saw the Fed in October, I think 25th, propose a reduction in debit interchange in the U.S. by roughly 28% for a $50 transaction. Now, this isn't new. This is simply continuing to implement the Durbin Amendment. And the Durbin Amendment charged that interchange had to be capped at a rate reasonable and proportional to issuers' incremental processing costs. And every year since 2011, when the interchange price caps were implemented for debit issuers with over 10 million in assets, every 2 years, the Fed surveys issuers for their costs, and every 2 years, those costs have fallen. And nonetheless, the Fed had not made an adjustment. So the Fed is not the culprit here. If there's a culprit, the culprit is Congress. So that has not been implemented yet, but it probably something pretty close to what the Fed has proposed will be implemented. We just saw a few weeks ago the UK's payment systems regulator declare that they want to take down cross-border interchange between the UK and European Union very dramatically, to 30 basis points and 20 basis points for credit and debit from 150 and 115. And this is by regulatory diktat. So this trend continues, and we've seen really no place in the world where there has been any, rollback or pushback by the industry. This is a cynical view, but there's kind of a Brezhnev doctrine of payments industry fee regulation, and once the fees are controlled, they can't be. It's never reversed. That becomes the new starting point for the next round of regulation. So I think that's a trend that continues. It's unfortunate. The industry is still healthy. The businesses that are regulated will navigate. I was struck. MasterCard announced a few months ago that the central bank in China had approved their domestic processing venture with NetsUnion to process domestic MasterCard transactions, which on its face, you would say, hooray, that's great. This is, a huge, huge payments market. However, I think, a stroll down memory lane probably is in order. 2001, China, as part of its 2001 accession to the WTO, committed to 100% opening up its domestic payments market by 2006. It didn't do so. 2010, the U.S. brought a WTO complaint against China, in which in 2012 it substantially prevailed, and China said it didn't appeal. And here we are, we're at the end of 2023, and there still hasn't been a single MasterCard or Visa domestic transaction in China. And it bears mention that in 2001, when that WTO commitment was made, China UnionPay, which is the domestic card network monopoly in China, did not exist. Alipay and WeChat Pay, the mobile payments networks, which are behemoths, didn't exist. Those three networks now are ubiquitous, enormously successful in China. So even if one took at face value that the market was really going to be open, which I don't, you'd have to be, I think, I'm naive. Then the market reality is it's pretty tough. So that's out there. I don't want to, it's negative, but the industry as a whole remains healthy.
That's great news. So, kind of with this same theme, looking ahead to the future, primarily our audience is individuals who work for organizations that process payments.
Yep.
And, so it's good to know that there's going to be some strong growth in the future. What kinds of advice would you give to them? Like, what would you say are the greatest opportunities they have in 2024?
Well, I think there's a continuing opportunity for almost anyone delivering payments to merchants to try and deliver additional services. And that's probably most true with smaller merchants, less true, the Goliaths, the Walmarts of the world, the Home Depots of the world, the Amazons. They have the wherewithal to source the whole suite of services they want to use. They're generally not looking to their processor. But most merchants are not gargantuas like that. Most merchants, are overjoyed, in fact, if there are integrated bundled services that help them run their business, help them generate incremental retail sales. And so I think there are always opportunities. I think the industry needs to be mindful that in some cases, so ISVs, percent or of payments continue to grow, and the very successful ISVs that have integrated payments, in many, if not most cases, capture most of the payments economics. So we will see in some cases, a shifting of the payment economics to, he who controls the end relationship. And then some of the traditional payment processors are relegated to the back end, which is bad in the sense that they get less payment revenue, but the attended costs are much lower as well because they don't have the origination cost, they don't have the servicing cost. For the most part, they're just pure processors, and the incremental processing costs are generally pretty close to zero. So, that's not necessarily bad. I would urge any company, firm, of sufficient size that isn't participating in some markets outside the U.S. to look for avenues to do that. Just simply with the view of expanding the opportunity markets that they're exposed to. What other advice? This is going to sound almost trite, maybe, but I think, growth with no clear path or target path for profitability is risky, and I think the market has less tolerance for that. I mean, we were in an era where people were willing to buy just growth with the view that then the companies, once they've grown, would figure out how to monetize at some point. I don't think that sells anymore, and that also, if you do that, you are not your own master. You're subject to how much capital, how much fuel you have in the tank. And in the current environment, that's a risky place to be.
Yeah, it sounds like a little bit like just riding the waves, right? Instead of setting the navigation system and having a targeted destination. So
that's right, and you want to be to the extent you can be in control of your own destiny.
Right, that's great. Well, Eric, I think that we have covered a lot of ground here. Super excited about what the future holds for the payments industry in 2024. I would like to share with our audience a link to the article that we referred to earlier in the podcast. So look in the description of the video for that
Okay.
article written by Eric. And I just want to thank you, Eric, first of all, for joining us here again today. I always just learn so much. You have such a wealth of knowledge in the industry. You must read every payment publication available. But I also want to thank everybody for watching today. Thanks for joining us.
Thanks, Donna, and Happy New Year.